Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Wednesday. It's March 23rd. It is the last or the beginning of the last week of March. It's 8 o'clock a.m., exactly 8 o'clock a.m. The market's going to open up in about 90 minutes. Jerome Powell is set to speak right now as we're doing this, which is kind of interesting. As you can see here right now, pre-opening about 90 minutes. And the volatility is pretty bad. Now, typically, if I saw the Dow down 139 points, I would be kind of nervous, but we've been seeing volatility, the ATR now on the Dow. I want to show you what it is right now so you could see it for yourself. It's one thing me telling you something, but it's another thing you guys seeing it for yourself. So if you look at the ATR indicator, you will see that the average true range, 60 points on the Dow. Now, that's equivalent on the diamond. Let me show you this. Because we trade the diamond. That's actually what we trade. That's equivalent to, hold on a second, 5.54. So we went from like 690 or like 694 to 550. So 550, 600-point moves on the Dow Jones, And here, if we go back to I was looking at the RSI before, but if you look at the Dow Jones, look at that. Look at the daily range. 650 points, 700 points, 780 points. I think we peaked at about 795 points on the 10-day average. Imagine the Dow swinging 800 points a day. So when you see the Dow, Jones, or when you see the futures, in light of the fact that the average move is 600, 700 points a day, when you see it down 156, that's really not all that meaningful, right? I mean, it's very little. If the range was 200 points a day, which is kind of typical, then 150 would be big. But with that said, the move on the NASDAQ is pretty big. Matter of fact, let's take a look at the ATR, the typical ATR on the NASDAQ, so you guys could see. And it's always good to measure volatility, because you guys want to do this yourself, because it's always good to see what the trading range is. So ATR is right there. It's set at 10 days, and I use a 10-day ATR. So you could see here, the ATR is 429 points a day. So again, it's quite a bit, but right now, we are down about 120 points, and it is a little bit it's a little bit nervous, especially with the Fed talking. Now, let's see how the market does today, because we've been fairly bullish the last 4 sessions, and the S&P is now above the 50-day moving average, which is a very positive sign. What's negative is the fact that the bond market is breaking down. The fact that the more the bond market breaks down, the higher interest rates go. The higher interest rates go, the more of a wet blanket that puts on stocks. So we actually want to see the bond market go a little bit higher to reduce the pressure on the stock market, but so far we're not seeing it. But with that said, even with that said, let's see how the stock market's been faring. Look at that. Look at that. Above the 50-day line. And if we today can go higher and break this high, we are one step away from this beautiful, beautiful 50-day moving average area and where my resistance is, which happens to be right around the same area. Total coincidence, which is the 560 area. So I'm looking for us to break the 451, and then I'm looking for us to break the 460 to the upside, and then we're going to be dealing with new highs. But again, it's a question mark of whether we're going to get there. And look at the bullish run we've had since the Fed has started raising rates. Now, one good thing about it is volatility is only up a point right now, and it's been going down, down, down. Now, it's been going down while we've been in war, while the word nuclear has been thrown around, while Russia has been battering Ukraine like there's no tomorrow. China, problems with China again, higher inflationary pressure, and volatility has been going down. Why? Because interest rates are low and the Fed has pumped so much money into the stock market. It's like putting, what is that thing they put in people's face for wrinkles, to prevent wrinkles? It's like putting so much into that where the face can't even bend. I forgot what it's called. I'll have to remember. But anyway, Botox. It's like putting so much Botox in someone's face. That's how much aid the Fed has put into this market, that it's very, very difficult for this market to go lower, and the volatility is not all that high. So sentiment levels, we're doing okay right now. Let's talk about global economy, and then I'll talk about individual sectors. So we had a rally on Wall Street led by tech companies for the last few days, which has been very refreshing to see. We've seen the dollar gain against the Japanese yen while the U.S. futures fell, which has been very interesting. It has to do with the fact that we're seeing a lot of inflationary pressure, which is causing the U.S. dollar to rise. Investors are watching what might happen with President Biden joining a meeting, NATO meeting, and EU summit Thursday in Europe, where sanctions and Russian oil embargo will likely top the agenda without a question. Mr. Man of the Year, Zelensky, was set to make a much-anticipated online speech in Japan's parliament. Japan, which usually keeps, they've been keeping their head in the sand. They expressed very much disdain for the current war we're seeing with Russia. And they're backing the sanctions that Western has against Russia, which is really, really good to see. Bond yields rose sharply for the second day in a row, which is what I was talking about right now, reflecting expectation of a more aggressive action by our best friend, Mr. Powell. We'll see how that goes, and he's speaking right now as we're doing this, which is kind of interesting. The big report for the week, it's not a heavy week report, it's a heavy week for Fed policy, but not for Fed news. The big report this week is going to be durable goods, followed by jobless claims. And we got the PMI, but durable goods is going to be a big report. Now, energy and commodity prices are already in a high demand because of the supply chain issues. Now it's even more, and we may see even more of the supply chain issues, kind of what we saw past COVID outbreaks. We may see that after the war. So I'm very bullish right now on basic commodities, metals, that sort of thing. The war in Ukraine has pushed oil, wheat, and other prices higher, and these higher prices and shipping problems make more expensive for businesses to operate. But my fear is, specifically on the commodities front, we may be seeing these bottlenecks for quite some time after the war. Investors will soon start seeing the next round of corporate earnings, which is very, very encouraging, because if you look at the overall stock market, and I want to show you the Russell 2000, because that's been the weakest stock market over the last 2 years or a year and a half. Look how well it's been holding on. I mean, look at how well it's been holding on. It's great. Higher highs, bullish rally. Look at the Dow. I mean, the Dow Jones is inching towards the 200-day moving average. It's right there. I mean, even if we go down a little bit but continue making higher highs, we're going to be in a much better position than we were a few weeks ago, because this uncertainty right here was really, really bad. But it looks like we're getting in much, much better shape. Again, all eyes are going to be on the SPY to see whether or not we can break above the 200-day moving average, and more importantly, stay there. So please, 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 please keep your eye on that. Now, this says pre-market we're up 3 points. What's going on here? That must be a mistake. Yeah, we're not up 3 points. We're actually down on the S&P. So that's a delayed quote. Now, let me go through some sectors with you, show you how things are moving up. Financials are looking great. I think financials are a no-brainer right now. I think we're going to be testing old highs, especially in light of the fact of what we're seeing right now with interest rates going up. Energies right now could go either way because of what's going on in the war, and most of it's priced in. I do believe we'll have another round of tops, but be careful with the energy market. We're a little bit overbought. I think utilities are going to stay around this area for quite some time. I think they're going to be choppy because energy prices will remain inflated, and that's going to impact utilities no matter what. I think consumer staples are going to go up for another round higher, or at least stay in this area, especially if the market gets defensive right now. Healthcare is kind of consolidating. Be very careful because this run-up may be a bit too much, and we may sag a little bit. Tech, I'm still liking. I'm hoping we can overcome this morning's downside because it's been looking really good. But if we do have a few down days, don't be surprised or in for a shock. Industrial, I think I'm very bullish on financial and industrial right now. These two sectors, I think they are going to start seeing the future. Higher interest rates, bigger supply chain issues. Consumer discretionary, we've got the same problem as technology. Not sure if the market is going to roil it or not, but the fact that we've seen, in light of the bad news, this much of an upside from consumer discretionary and tech, and the fact that the S&P is above the 200-day moving average is very, very promising. Basic materials passed through their resistance level and are now set to go higher. I like financials, industrial, and basic materials a lot right now. Big question mark on communication services. Are they going to lag or are they going to continue? Odds are, and the fact that it's a downtrend, say that we're going to go a little bit lower. Real estate, I think it's going to cool off a little bit. I think a lot of investors are getting worried about higher rates. Now, today is Wednesday. It's a hump day. I'm going to give you my number one stock and my number one short stock. So my number one long play is Lockheed Martin. I think this pullback from the 482 area to the 411 area is a little bit overdone. I think the stock wants to go a little bit higher right now. It's defensive. We talked about the stock. We spotlighted the stock on February 7th when it was at 392. It went all the way to 482, about 100 points since we talked about it. It's now a little bit lower, and I like it again. You could put a stop loss right at the 50-day moving average, but I think we're going to start hitting the highs again on this stock. LMT, like the stock to the long side. To the short side, Vontier, VNT. I mean, this is it's a horrible company. It's a totalizing fluid meters, counting devices, focuses on transportation, mobile solutions. The stock is down for a year, 23%. The numbers, negative growth. It's a horrible stock. Whatever they're doing, it's horrible. And as you could see here, they haven't really been doing all that great. The tech stocks have come up, but it looks like this stock is set to go a little bit lower right now. Again, you may want to buy a put option and put a stop loss right around the 26 level. But I think the stock is a dog right now, a big, 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 big dog. So be very cautious. Keep your eye on the S&P 500 and keep your eye right now very, very carefully. Keep your eye on the 200-day moving average and yesterday's high, which is at 450.63. If we can take out yesterday's high, we're looking good. If we can't, and I don't know if we can. If we can't, we're going to start coming back down. Now, before I let you go, I want to tell you something very, very, very important. Even if investors could figure out today's insanely volatile markets, there's still too many disadvantages to deal with. And it's no secret, Main Street traders are fighting an uphill battle against Wall Street's automatic trading machines. Now, these supercomputers, they can execute thousands of trades in a matter of seconds, triggering massive stock runs before average investors even have time to blink. Man, oh man. Now, everyone, the average Joe, the average John, you guys, everyone has the opportunity to make the same lightning fast trades as the pros on Wall Street, all thanks to a trading algorithm that I developed. Now, I went live on Tuesday to reveal my super stock trading strategy. Don't worry if you missed it because we recorded the whole thing. You guys are going to love it. Follow the link below. Check it out right now. Click the link below. Watch it. It's time sensitive. It's all meat and potatoes. I go through 4 parameters that you can apply to your own trading strategy, even if you don't join me, and to show you how, if you apply them to the S&P, your returns could have went up 22%, 22 times that of the S&P. Can you imagine outperforming the S&P by 22 times? I want to show you how, and I want to show you the 4 markers that do it. Very important stuff, no cost, no funny stuff, no monkey business, no bait and switch. Follow the link below. And if you guys are getting value out of these videos, let me know. Bye, guys. I'll talk to you soon. Have a great day. Send me love letters. Support@marketgeeks.com. Bye, guys.